The artificial intelligence theme is coming to a screeching halt. Yes, folks, one of the biggest companies in the AI space that has been one of the best performers in the stock market over the past 3 months by the name of C3.ai is coming under fire from a massive short report alleging the company of accounting issues. Now, this is obviously on paper a massive concern to investors and even prospective people who want to be involved in the AI industry, because it goes to show you that the AI industry's growth might not be as strong or real as many people thought. But I'll be honest with you guys, I don't think that's the real case. In this video, I want to explain to you why I don't think Kerrisdale Capital has a valid argument against their short thesis on C3.ai, and I'm also going to go over what I think the AI industry is really going to do over the next 2 to 3 years. Because as somebody who's been an investor and follower of the C3.ai company for the past 12 to 18 months, what's been going on with ChatGPT and the AI movement is truly just the beginning. And in this video, I want to give some hints as to why I think that is the case. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, let's try to understand what C3.ai actually is from a business perspective and what Kerrisdale Capital is accusing this company of doing. This isn't a Microsoft Azure. This is not an Amazon Web Services. This is a company that sells AI as a software package to other businesses that might want to leverage it for their own purposes. This is obviously a very important deal because AI is a very difficult technology to master. Not only is it difficult to deploy, it's also difficult to hire talent for and develop in-house. What C3.ai does is they make a suite-based platform that can be leveraged and licensed and subscribed to from other companies like you see here. And the reason why this is such a big deal is because there are just so many industries that can benefit from the usage of machine learning and reinforcement learning. Not only for predictive analytics, but also reliability maintenance, reducing cost, and understanding what investments a company should be making in at the right place at the right time based on past and future projected trends. Because the more sensors, the more data a company is collecting, the better their AI model will work. And that is exactly the leverage that C3.ai is providing their customers. And for those of you wondering, how exactly does C3.ai even make money? Well, they make money from subscription services. C3.ai charges their customers at an undisclosed price, which obviously is a very high margin revenue stream, meaning a lot of it gets converted to the bottom line. As you can see, their gross margin for the past 12 months has hovered around 66 to 75%, which obviously is right in line with what you would expect with a SaaS business. And to be honest, folks, I'm not even going to try to paraphrase what Sam Aderangi, the CIO of Kerrisdale Capital, is accusing the company of. Instead, I'm going to let you guys listen for yourself the main points he's making.
And so, the first thing that we mentioned is the unbilled receivables. This company had made about $260 million of revenue in the past 12 months. $80 million of that is unbilled receivables. What unbilled receivables means is that you're booking revenue, and yet it's not just that you haven't received the cash, you haven't even invoiced the customer. More than 30% of the customer's revenue, they haven't even bothered invoicing the customer. Who is that customer? Baker Hughes, which is a shareholder. It's a related party. And it's really a company that's just contracted to be required to purchase, to give C3.ai revenue, mostly because it was given discounted shares in 2019 before the company's IPO. So, at the end of the day, this isn't real revenue in our opinion, and it's accounting for 30% of the company's revenue over the past 12 months. I just don't understand how this is at all okay.
But this isn't the only company that uses unbilled receivables. So did you compare it to its peers and to other software and tech companies? I mean, just how unusual is this?
Software businesses like this do not have unbilled receivables. That's 30% of the company's revenue. I mean, this is not a construction company.
Now look, I don't hate short sellers. I'm not going to go after these people just because they disagree with what my opinion is. This is a free market. You can do whatever you want, and you are free to voice your own opinion. But there is a line between spreading misinformation and spreading real fraudulent activity. And in this case, what Kerrisdale Capital is accusing the company of is alleged accounting mispractices, which in reality are actually completely legitimate and already done by a lot of businesses. This is all a part of the generally accepted accounting principle method, or the GAAP method. Now, first of all, unbilled receivables are not necessarily a good thing, but they're also not necessarily a bad thing. These tend to just be an outcome of what happens when you're running a subscription-based SaaS business. And here's why. Some of the big reasons why unbilled receivables occur is because of invoice delays, advanced payments, and contractor-related billings. And in this case, Kerrisdale Capital is simply accusing C3.ai for having too much unbilled receivable, which they estimate is around 30% for their fiscal year 2022. I want to repeat that once more. This isn't a problem with the revenue of the business or how they're actually operating with their customers. Whether or not there's a value proposition, a business model or not, that's not the question. The question is how much of their revenue is still not recognized. And to be honest, I don't find this to be as big of an issue as people are making it out to be. Because when you have an unbilled receivable, you are still generating services for the company from which you are owed the receivable from. It just means that your money that you're going to receive on your income statement is going to be delayed for at least a couple of months. It means that your service has already been provided to the business and that they are willing to pay for your services, not just now. And apart from meaningless comparisons to companies that don't even compete in nearly the same industry that C3.ai is competing in today, there are a multitude of reasons why Kerrisdale Capital has an inherent bias about shorting this company today and at this price. And it obviously has all to do with ChatGPT. In 2020, 2021, or even last year, nobody batted an eye for AI companies. AI was obviously a complicated technology in itself, and obviously most people just knew it as a buzzword. But this year is when investments really start to pick up in this industry. And the big reason why C3.ai is the main focus of short sellers and skeptics is because it happens to be the smallest company out of all the AI dedicated business, particularly on the Forbes list. And as you can see, although the stock was down significantly in 2022 for good reason because of rising interest rates, the stock outperformed the Nasdaq by a huge margin in 2023 up until obviously the short seller report. And this obviously caught the eye of traders, investors, and even skeptics as they found opportunities to play the downside. So it's really important to remember that short seller reports are inherently biased for the price. As an investor, however, which is what I've been in this company for the past 12 to 18 months, my bias is towards the performance of the business, not necessarily what the price is going to do in the short term. And as you can see, C3.ai's revenue is still near record highs of $66 million on a quarterly basis. And in terms of the idea of this company being a liquid or potentially going bankrupt because of the losses in the short term, which obviously is expected from such a young company, the company's balance sheet is impeccable with cash and cash equivalents of almost $700 million with current assets at almost $1 billion. That is compared to debt, which totals to just $150 million, with current liabilities of only $123. And despite tougher competition, a slowing market for venture capitalists, and investments from companies, C3.ai is still expected to grow around 1 to 7% in fiscal year 2023. Whether it be C3.ai or any other business in the machine learning or reinforcement learning space, I think the AI industry is just getting started. There is no way that you can slow down the massive benefits generative AI will provide, and because the profit margins are so high, profitability and cash flow could be massively rewarding in this sector, which is why I think this is one of the best industries to not only learn about, but also potentially invest in. And as a matter of fact, while I was actually filming this video, C3.ai came out with a rebuttal to what Kerrisdale Capital just mentioned, not only around their GAAP principal accounting measures around unbilled receivables, which I already covered, but also their gross margins, which, as they say, are not actually 99%, like Sam Adurangi, the CIO, alleged. This actually happens to be of a one-time transaction where C3.ai purchased expert services from Baker Hughes, which is an oil and gas giant, in the amount of $600,000 to support a third-party customer, meaning there is basically no cost of revenue associated with this sale. And it seems like even Jim Cramer, which is the perfect person to take investment advice from, is now trashing companies like Palantir and C3.ai simply because they've been underperforming for the past 48 hours instead of outperforming from a business perspective over the past 12 months. If this is not the ultimate sign of being a contrarian, I don't know what is. But as usual, guys, let me know your thoughts down in the comment section below. Nothing in this video is financial advice, and this is just my opinion. Let me know your thoughts on the AI industry, what C3.ai is being alleged for, and whether or not you think this is really a hype bubble that is going to end worse for investors. Let me know your thoughts, and I'll catch you guys in the next one. Take care.